Andy, how are you? Welcome back to F.A.C.E.
Hey, thanks for having me, Dale. I appreciate it.
Yeah, so Andy, what's top of mind for you? I know a lot of people, the PCE, or do those things even matter with the way you approach the market?
Well, I'll put it in context, but the thing I'm looking at most carefully is what Powell has to say. I think it's an important data point, and we've gotten a lot of other governors speaking, which is indicating, and the minutes as well, indicating some sort of divergence amongst members. But
do you want to share? Do you want to share your screen, Andy? Do you have anything you want to, visually share with us, or
yeah, let me set that up
at the bottom? And while you're doing that, Andy, confirm my memory. Last time was the first time you were on.
Yes.
And at that time you were bearish equities, I think was in August, and you were also bearish gold from, sharply higher levels even after this rally that we've had here.
Yeah.
Do I have the right guy?
Yes, but my position's changed quite a bit. I
know. I'm sure it did, but they worked pretty big.
Yeah,
because I remember going.
That
was a great call by you, huh?
We had some good luck. Let me
you humble son of a bitch, you.
What I think reflects some of my calls best.
All right.
So this is so let me step back and say the important things that are on my top of mind when I invest, and my horizon is 1 to 3 months typically, is by far the biggest thing that's driving markets has been shifts in risk premium, driving all assets. And in particular, starting back in December, when Powell mentioned the balance sheet, QT drumbeat started to get front run, and you saw a significant sell-off in all assets. And this graph is a portfolio of assets that's balanced to growth and inflation, things like an all-weather, things like, it's not that different than a 60-40 would have performed, but, is more comprehensive. And so what it reflects is that people don't want to own assets, they want to own cash. And it's been going from the upper left to the lower right through November 2nd. And let me just move this to the right thing. I updated the graph this morning and it's not perfect. So those flows depend on how much quantitative easing is done, and then how much issuance is done, and recently how much quantitative tightening is done, and that transmission mechanism is the issuance of government securities by the Treasury. And that headwind has made people not be interested in owning assets, along with hiking, which has generated an attractive place to park cash.
Money. Yeah.
Right. So those are the big flows. And now the question is, where are we on the wiggle? And I've had some good fortune in catching some of those wiggles. Greens are buys, reds are sells. But I missed it when the inflation number hit. And since then, I said we should sell because of some data I saw regarding the massive amount of issuance in Q4 and Q1 that came as a surprise to markets. But the CPI number changed things. Yeah. And so if you look at the far right, where we spiked up massively, 2-4% or so.
That was a 7 sigma event. Can you define that for our audience? What is a 7 sigma event?
I didn't calculate the actual sigma, but a 7 sigma event is something that should not happen not the, I think the world's lifetime, but certainly civilization's lifetime.
And that's
In
happening. Well, so what's that tell you about the markets when that can
Right,
happen?
right. And so the question is why? Why did we have this rapid spike post CPI? And so what I'm looking at first is, well, let's see what happened. Well, bonds are up 10%, long-term bonds are up 10%, SPX is up 8%, gold's up 4%. Half of the rally in bonds was seen in real rate rallies, where both inflation expectations and real rates fell.
Dollar's down 10%. So is it all
Dollars,
nominal? Is it all
dollars down.
nominal on the dollar break?
Yeah, yeah. So
It could
dollars
all
down.
be nominal then, these
Right,
gains. All
right.
right.
And then commodities are down. And so how does that all add up? So first you have to say, in a world in which bonds are up, the most natural thing to look at is recessions getting priced in. And I think that's the broad narrative, that we're now heading toward recession and the Fed is going to ease in some way, at some point. But as I reflect, the difference between here and here in the 1 year, the next year worth of rate hikes as priced by Fed funds is really unchanged. Briefly, a lower terminal rate got priced in, but then soon after, the market started fading again, 2-year notes faded, and really nothing is priced in that would indicate the Fed's path changed based on the CPI number, which I think is an interesting insight that I'd suggest people take a look at.
We were talking about that today, the 10-year, the action in the 10-year looks a bit corrective, and one negative number, one word from Powell, and all of a sudden you could see new highs in the 10-year at 440, 450.
Right. Which
is that what you're thinking, Andy?
I'm not thinking that high. I do believe there is a potential for a significant backup in yields, but I'm short the 10-year.
Okay.
So
that's contrarian right now.
Yeah, and I shorted it basically in here.
Okay.
And so 113.10, I think. I used options, so I don't have a price precise thing.
Okay.
But I think the question that one has to ask is this recession being priced, or is this a massive short covering? And so most of my work over the past 2 weeks has been trying to identify who did the buying. And are they long, are they flat, or are they still short? Because I think that's important in terms of positioning.
More fuel, more fuel for the market to squeeze.
Right. And so the most obvious characters that took bonds and stocks up are the CTA trend following in the bond market case, and the what I call portfolio insurers, which use no one cares to buy equity puts anymore because they perform generally badly in down markets. You actually see down volatility and underperformance of the hedges versus their costs. So many have shifted to traditional, and I'm a dinosaur too, traditional 1987 portfolio insurance where they chase price. And on my site, on my Twitter feed, I show that graph. I don't have it here.
So was this performance anxiety? All the money managers, hedge funds had to come in and show these names into year end to keep their accounts?
You know, I think so. It's an interesting thing. There's the general idea of performance anxiety, Santa Claus effect, all those names for it. And this is an unusual year in that long-only portfolio managers that, or even net long hedge fund managers that are, long short, which all still have a positive, market exposure. None of them are getting bonuses based on performance. And so there's not a lot of incentive for performance chasing, because all you end up doing is marking up your portfolio for no bonus. So that mechanism, I think, is a false flag in years, and it's very rare that you have years that are down substantially. And in none of those, again, very few cases, but in none of those cases do you get a Santa Claus rally.
Did you find that there were still shorts left after that event?
Right. And so the important thing, I think the equity move is less interesting, except for the fact that, so let me just step back. If the bonds went up, stocks should have gone down if they're pricing a recession, but they didn't. They rallied as well. So let's start with the bonds. The bonds seem to have gone up, not because of new longs, but because of the unwind of existing momentum-driven shorts. And so in bonds. So that seems to be the root cause, because, as I said, the Fed's hiking path hasn't changed at all. QT hasn't changed at all. Yes, we're getting closer to a terminal rate, but to like long bonds or even 10 years at this yield, you have to think we're going into a recession by 2024. And if you think that, it's hard to like equities. So I don't think both of these things can be correct. The bond rally, to me, is a short covering rally from these CTAs. And if you look at their performance on the day of the CPI, and subsequently as the bond market has extended, their losses have gotten smaller through time, which is consistent of position flattening. So my observation is that CTAs are mostly done and aren't going to buy bonds. And the equity flows are just performance, are just portfolio. They are mechanistically, when the market goes up, they buy, and when the market goes down, they sell. And they have significantly levered up. Let me just briefly bring that chart up.
Interesting. So who are these people? Would you call them institutional buyers?
For equities?
Yeah, for equities.
Yeah, so my favorite, again, I use many metrics, but this is a rough one that I find useful. And if you look at this chart, what you see is for the
we're still looking at the same chart here, Andy.
Oh, are you?
Yeah.
Let me new share.
One of our attendees, I thought we were still talking about it. It's Monday.
Yep.
But we
here
understand
what
you're saying. Okay.
You see this? You see this Bloomberg?
Yeah, got it. Yeah.
Okay.
Got it.
So if you notice, for all of the first quarter, they sold. These are long-only asset managers that self-define as being unlevered. So it's your average portfolio, pension portfolio, insurance portfolio, or mutual fund portfolio. And so they sold all the way down to the lows. And now I don't have the SPX next to it, but we know the lows in March. Then they bought into the massive rally that ended on March 31st. Then they sold all the way to the June lows.
Yeah.
So they chase price. And as you notice, they make the lows and then they reverse. And so they've been chasing price for, and are quite levered relative to the August high and the May high, the May high.
Yeah.
So my sense is these guys are the ones that have driven the equity rally that paused briefly when the Fed spoke, but then relit soon after. And I think those guys are what are driving the equity rally. So
when you say levered up, they're doing it on margin?
So, these are long only funds. So what they do is they're not levering up, but they have, they always keep some percentage of their portfolio in
cash.
in cash, which they can use to buy margin futures.
I see. Okay.
And so
Okay.
I think we have seen both of those things happen. CTA covering, which doesn't really create in the bonds, and equity managers re-levering. So when you add those two things up, this is not a Fed easy money thing. This is a animal spirits chasing thing. And I think the narrative is just wrong on whether what's being priced, because
well, what's being priced is peak inflation and a 20 VIX. So before today's opening, let me ask you, do you feel more comfortable with the shorts in the notes rather than shorting this rally in stock indexes? And
so
why, if so?
So I have a right now I have a short position in notes and a short position in SPX and NDX.
Okay.
I'm a little bit more constructive on the dollar. I'm long the dollar versus pound and long the dollar versus Nikkei. Sorry.
Okay, why the pound rather than euro?
So I think the UK economy is closer to what some have labeled a developed market currency crisis, where they have great demand in the capital markets for issuance, and they also need to import a hell of a lot, and that's pretty negative. And I think let's speak about bonds and the eurozone. The ECB is the most behind the curve of any central bank, and so I think there's going to be a significant catch up there over 2023, and that's why I'm particularly negative on bonds, and actually think equities in Europe will actually outperform bonds, just like bonds, just like
because the euro is going to remain somewhat strong against the dollar. Could that be it? Just the denomination?
Yeah, possibly. But I think it's really just financial conditions are still easy and too easy in the eurozone and need to tighten. And while they're easy, that's a sweet spot for equities. And really, it's not to say that I'd go long equities. It's just I think bonds will significantly underperform European equities. Similar to the way they have the US bond market has massively underperformed the US equity market in 2022. I think 2023 will be a similar 2023 in the US will be a convergence where bonds will outperform equities, but in Europe we're behind, and I think bonds will underperform equities in the eurozone as they catch up.
Wow. I'll tell you, Andy, you sure provide a real nice picture across the board assets and the reasons. You do a lot of detective work, and you know, and
I may not be right.
Huh?
I may not be right.
Right, of course. Who's always right, Andy?
Right, exactly.
You know, I mean, we don't expect our guests to, always be right, but the insights on the bonds being short covering and that you're constructive the dollar, which a month ago that would have been a consensus view.
It was
right?
super crowded. The work I do, that's detective work on that, had me being so the most crowded pair by far from my work a month ago was pound dollar. Everyone hated the pound, and positioned that
it's going to go under parity, and we had a major bout.
And that rally did not surprise me. I didn't catch it, unfortunately, but that imbalance of positioning has massively reverted. And so now I think it's more about the fundamentals than the positioning. And so I'm more bearish on the
the backdrop.
The UK fundamentals.
They've had 7 presidents in a few years.
Yeah,
right?
exactly.
That too. Can you imagine, Andy?
Yep.
So, I want to wrap it with this one question. Based upon your view on the notes and that yields could rise again, do you have a view on US dollar yen? Because there was, up until recently, a pretty tight correlation with yields and US dollar yen. Do you have a view on that?
Yeah, and it's just about central banking. I think
Okay.
Kuroda is going to do what it takes through April. Obviously, who takes his place is going to have an issue, is going to be an issue, but also the fiscal side is finally stimulating. And a
Okay.
combination of the US getting tighter and Japan getting easier is likely to be bullish dollar yen.
Okay. Andy, what's the best place for people to follow your work? I know you have a private Twitter where you keep people in touch with things that are changing. What's the best way
Yeah, so
to do it?
the intro to me is my at Damp Spring, which is my Twitter handle. I have a lot of followers, but I also tend to be extremely approachable and answer lots of questions on that public feed. I do have a private feed that's a subscription model that has right now is at capacity of 250 members and is has a basically a 200-person wait list. So join the wait list. It does open up on occasion. DM me if you
Oh,
have
get some
particular
more
interest.
bandwidth. People are clamoring and they're riding in the streets to be able to get in.
Yeah, it's a
And you,
blessing, but I do offer a lot of value and a lot of personal hand-holding and
yeah.
education on that site.
Okay. Last thing, gold. You made a great
Um,
call last time. Are we entering what could be a window if we had one more break in gold to back
you
up the
know,
truck?
so gun to my head, I think gold is geez, I think I'd have a hard time with a gun to my head making a call on gold. I honestly don't have a strong enough view to say
All
whether
right,
it's go
that's
up or down.
I don't. You know what? Try this. It's very cathartic. You probably don't say it much. I don't know.
I do say that. I was
All
trained
right.
in Bridgewater, and that's all we ever say.
Yeah.
I,
All right. Well, I'm just saying that. So I remember when I was younger, I had a hard time saying that because it's really wisdom to say you don't know.
it's the best.
Instead,
It's the best energy you can have. If you know you don't know,
yeah.
you have a superpower.
Oh, wow. I really feel I've gone through a metamorphosis today. But Andy, eye-opening, some great ideas, very nice narrative, and we all appreciate you coming here with your giving spirit and sharing this work. I know you put a lot of energy into it, and you have many years of, you know, being a market participant and a market watcher. So
Thank you, Dale. I appreciate the opportunity. Anytime.
yeah, it's great. So I'll get a hold of you later and keep you going in the rotation, Andy. And I wish you and your family a happy holiday season.
You too.
All right. So
Thanks, Dale.
everyone, Andy Constan, follow him at Damped Spring, DAMPED Spring. Should be part of your intelligence gathering. He does great macro. All right, so that's a wrap, and you could join the team in 18 minutes on the Morning Edge. Remember, everyone, don't just count your pips, count your blessings, and we'll see everyone for Turnaround Tuesday. Adios. Thanks again, Andy.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.